Good morning, everyone. I'm Spencer Applebaum, a general partner and co-head of venture at Multicoin Capital. Multicoin was founded in 2017, and today we're a multi-billion-dollar asset manager with a large liquid-focused hedge fund and a series of venture funds. We recently published a 44-page report laying out our analysis and valuation of Hyperliquid's native token Hype. And today I'm going to try to summarize all 44 pages in about 10 minutes. Before I get started, brief legal disclaimer. Multicoin has a position in Hype, obviously. The valuation methodology used in this report is opinion-based, provided solely for the purposes of discussion. The report's available on the Multicoin website and should be read in conjunction with this. And nothing I say today is investment advice or an offer or solicitation for any Multicoin fund. Please do your own research. All right, let's jump in. So Multicoin itself has been investing in exchange infrastructure for about 7 years at this point. In 2019, we published our first report on BNB when the token was trading at roughly $10. For anyone who wasn't around back then, Binance was already the dominant crypto exchange. But we thought the market was drastically underestimating two things. One, how quickly liquidity can compound, and two, how much value a well-designed exchange token can capture. A lot's obviously happened in the 7 years since, and BNB now trades at roughly $563. We believe we've found the next BNB style setup in Hype. In our view, the market's drastically underestimating what Hyperliquid can become. It has strong fundamentals today, along with several upcoming catalysts that we think can meaningfully accelerate both the growth of the exchange and the value of Hype itself. So most people who are here in this room probably already know that Hyperliquid's a vertically integrated layer one purpose-built for high-speed trading. But even people who know the product often don't appreciate just how good the exchange itself has become. When you look at the data, Hyperliquid has effectively reached parity with many of the largest centralized exchanges. It offers roughly 200 millisecond confirmations, and in some cases, its BTC perpetual order books are actually tighter than Binance's. So it delivers centralized exchange level performance and execution without requiring users to give up custody of their assets. It's an extremely powerful combination. To level set, perps are probably the most important financial instrument in crypto, right? They represent roughly 3/4 of all crypto trading volume, which was about $85.7 trillion of derivatives volume in 2025. Historically, obviously, all of that, I should say almost all of that activity happened on centralized exchanges. But derivatives dexes themselves have actually gone from more or less zero market share in 2022 to roughly 16% today. And that's a pretty major structural shift in what we think is a very large and still growing market. Within the market itself, Hyperliquid has clearly emerged as the market leader. Its monthly perpetual volume is now approximately 17% of Binance's. It's probably even higher today. This was made a couple days ago, but up from effectively zero just 2 years ago. And importantly, that's not happening because Binance is shrinking or anything. Binance is actually continuing to grow. Hyperliquid just happens to be growing a lot faster, expanding with the overall centralized and decentralized exchange market, while also competing directly with a lot of these large centralized exchanges for things like users, volume, and liquidity. So we believe there are generally three structural reasons why Hyperliquid is gaining ground against centralized exchanges. First, FTX and other major CeFi failures throughout 2022 fundamentally damaged trust in centralized exchanges. Traders like ourselves, we operate a large liquid hedge fund, are much more conscious of counterparty risk, and the rest of the market are increasingly reluctant to leave large amounts of collateral with a centralized operator, which is especially important in derivatives when you have to leave margin on the exchange. Second, purpose-built chains like Hyperliquid have finally made on-chain execution competitive with centralized exchanges, right? Traders no longer have to choose between the trade-off of self-custody and a high-quality trading experience. And then third, centralized exchanges are facing growing regulatory and therefore geographic restrictions, while DeFi obviously will remain globally accessible and permissionless. Together, these forces are pushing trading activity on chain, and I think as that shift continues, Hyperliquid is going to be the biggest beneficiary. So all of this activity is beginning to add up, and the numbers themselves actually tell a pretty compelling story. Hyperliquid generated roughly $873 million in revenue on 2.9 trillion of trading volume in 2025. Its user base more than tripled to about 900,000, while OI also tripled to about 6 billion. Importantly, Hyperliquid now consistently generates more revenue than any other layer one, including Ethereum, Solana, and Tron. So in our view, 2025 was Hyperliquid's kind of breakout year. As I said just before, at this point, Hyperliquid generates more revenue than every other layer one. It also generates more revenue than every other application in the industry. Our thesis, though, is not simply that Hyperliquid is a great perpetual exchange for crypto assets, but our thesis is that it's going to continue growing rapidly because its TAM is about to become much larger, and there's really three major catalysts that we think are going to drive that. So the first and probably most obvious one to everyone here is HIP-3. HIP-3 made market creation permissionless, and today Hyperliquid is the only major exchange that has made this concept of permissionless market creation work at any real meaningful scale. Within 6 months of launch, HIP-3 open interest grew from 0 to approximately 2.9 billion. And importantly, obviously, many of the largest HIP-3 markets are not crypto assets, right? They're commodities, equities, indices, pre-IPOs, things like that. When U.S. airstrikes in Iran sent oil prices roughly up, 30%, I think, over a weekend in February, CME and ICE were closed, right? But Hyperliquid wasn't. Its oil perp traded more than $1.2 billion of volume in a single day. And even since then, it's still continuing to generate a ton of volume for the venue. Another cool thing was during the Cerberus IPO, the Twitter actually found a photo from the trading floor where Hyperliquid is visible on trader screens. That's the image you see there. So traders were using Hyperliquid in real time to understand where the stock might open. And then another example here is in March, the Dow Jones licensed the S&P 500 for the first efficiently licensed perp to trade XYZ, obviously. And then during the SpaceX IPO, and a lot of people don't talk about this, but new wallet creation on Hyperliquid on the day of the IPO actually increased roughly tenfold on that day. So I think the important point here is Hyperliquid's becoming a venue for price discovery well beyond crypto. And again, I think that's why we think it's increasingly a misnomer to call Hyperliquid a crypto exchange. It's becoming the everything exchange, coined by our friends at Syncrasy, a global, always-on price discovery venue for almost any tradable asset. And I think that distinction is central to our thesis, right? The market is currently valuing Hyperliquid primarily as a fast-growing perps DEX, but I think it's becoming something much larger. And that gap between what it is today and what it can become is kind of the core of the opportunity. I think this slide does a really good job of putting that opportunity into context. So crypto trading is already obviously an enormous market, but it's still extremely small relative to global trading activity across asset classes like equities, commodities, rates, currencies, and other traditional financial assets. Hyperliquid obviously does not need to and probably won't replace CME, NASDAQ, or the entire traditional financial system for this opportunity to matter. It really only needs to capture a small portion of the trading activity that wants to move toward global, always-on, and programmable markets. Even a modest share of TradFi trading would represent a dramatic expansion of the TAM for Hyperliquid, and I think HIP-3 gives the exchange a credible path to doing exactly that. The second catalyst I want to touch on is builder codes. Builder codes effectively turn Hyperliquid into a headless exchange. So they obviously allow any third party to own the UI and the customer relationship while they route execution into Hyperliquid's underlying liquidity. And the model's already working. So platforms like Phantom, MetaMask, TradeXYZ are obviously building on top of Hyperliquid. And these builders spend money acquiring users and designing products for specific audiences, where Hyperliquid provides the liquidity, execution, and settlement layer underneath them. The individual builders, importantly, can focus on things like distribution and complying with local regulations and regional go-to-market strategies without having to build the underlying exchange themselves or fragment a global liquidity pool that is Hyperliquid. The third catalyst, I think, is, and this one's important, it's HIP4, HIP3, and portfolio margining kind of all tied together. So HIP4 is going to bring prediction markets and options into the same margin system as the rest of Hyperliquid, and I'm sure there's a lot of talks today about it. That's structurally something that standalone prediction markets like a poly market cannot offer. Portfolio margining then will allow traders to manage all of these positions together, right? So, for example, a trader could be long BTC, short the NASDAQ to hedge, and then own a prediction market tied to an upcoming FOMC decision, all inside one count and under one unified margin system without fragmenting. In traditional finance, creating that same portfolio might require integrating into 4 different venues, like I use on here, Binance, NASDAQ, CME, and Kalshi, which are all separate margin systems. On Hyperliquid, those can be managed together. So we do expect HIP4 to become a major growth vector for the exchange, and then portfolio margining to amplify its impact by making capital much more efficient across the entire stack. And then why we're all here, or why I'm here, Hype. Importantly, the vast majority of the economic activity that's generated by Hyperliquid accrues directly to Hype, right? There's no separate equity cap table, there's no preferred shareholders, there's no group of private VCs like me with a competing economic claim. The team, the users, and the token holders are all aligned around the same asset. Nearly all protocol revenue, 99%, is directed towards purchases of Hype through the assistance fund, and the fund's already actually accumulated more than 45 million. It might be 46 million by now, but at current prices, that's about $2.8 billion, and that's all been done through open market purchases. On top of that, though, staking discounts encourage market makers to hold the token so that they can get lower fees. Hype's used for gas on Hyper EVM, and the token obviously secures the network for validation. By the value capture framework we've basically used since our original BNB work, Hype checks every major box. So this is the slide that everyone always talks about. At approximately, I didn't update this today, but let's just call it $63 to be nice. Hype trades at around 36 times trailing earnings. Once you include the Coinbase agreement that'll turn on in August, that's closer to about 30 times forward earnings. Our base case when we value Hype relies on 3 different assumptions that we believe are deliberately conservative. So first, we assume that the overall derivatives market grows at 35% annually for crypto specifically, which is actually slower than it's been growing over the last 5 years. Second, we assume that DEXs will double their market share to 32%, roughly in line with actually the pace of share gains over the past 3 years. And then third, which is by far the most conservative, we actually assume that Hyperliquid gains no additional share within DeFi, specifically on volume, even though it currently represents 60% of OI and a much smaller percent of volume because a lot of competitors incentivize trading volume. Those assumptions produce roughly $8 billion of earnings in 2028 that flow to the Hype token. If you apply a 20 times earning multiple, which is actually below where Coinbase and Robinhood trade, that produces a value of approximately $300 per Hype in our base case, roughly a 5x from here. Even in our bear case, which assumes that the derivatives market only grows by 10% annually, which is really low, that produces a value of $109 a token. Importantly, all of these assumptions in the base case, they exclude things like HIP4, Hyper EVM, and any potential fees that come from priority, which we're starting to see grow already. So as you can probably tell, we're extremely bullish on both the Hyperliquid ecosystem and the Hype token. Please come find me afterward if you have questions about the report, the valuation, or any part of our thesis. And also, please come talk to me if you're building something ambitious on Hyperliquid. We'd love to, explore potentially backing you through our venture fund. Thank you.